Recap. I'm Daniel.
And I'm Mira.
So today, the stock market just gave us an absolute masterclass in split personalities. I mean, you look at the board and there's the Dow, right? Just marching steadily to new record highs, looking perfectly calm.
Yeah, totally unaffected.
Exactly. But then, while that's happening, Nasdaq futures are suffering this breathtaking, violent 1,000-point intraday collapse. And just to, throw gasoline on the fire, gold spiked a massive $114.
Right. It really was a day of two completely different realities. I mean, if you had to summarize the underlying current, tech valuations finally collided with financial reality today.
Yeah, a really hard collision.
For sure. But at the exact same time, we had this shockingly weak U.S. labor print that completely flipped the script on interest rates, and that sent absolute shockwaves straight through the bond market.
So we have a pretty dense stack of material to get through for you today. We're going to unpack that jobs data. We'll examine the geopolitical tensions aggressively moving commodities right now. And we absolutely have to dissect that meta-driven reality check on AI spending.
It's a heavy lineup, but, a fascinating one to untangle.
It really is. Before we jump into the deep end, though, we want to explicitly state to you, the listener, that this deep dive is strictly for market context and educational discussion. It is absolutely not personal investment advice or an investment recommendation.
Right, just keeping things in perspective.
Exactly. All right, so with all this chaos, the first question we have to answer is, what set the stage before the U.S. session?
So the overnight mood for global markets was heavily dictated by this major risk-off shock coming out of Eastern Europe. Specifically, late yesterday evening, so July 1st at 6:56 p.m. Eastern, Time reports confirmed a massive, highly coordinated Russian missile and drone strike on Kyiv. And the critical detail for markets is what they targeted. Because they didn't just hit random areas. They precisely targeted energy infrastructure.
Yeah, specifically the facilities operated by Ukraine's power company, DTEK, right?
Yes, exactly. The strikes caused widespread power outages across the grid. You had structural collapses of residential high-rises, and tragically, at least 5 deaths. It was a really potent reminder of the fragility there.
And, the reflexive framing for these geopolitical events is almost always to just treat them like unpredictable natural disasters.
Right, like they just happen out of nowhere.
Exactly. A strike happens, markets react, and consensus just calls it a random tragedy of war. But let's look at this through a game theoretic lens for a second. Are these really just random acts of aggression?
Well, what's the alternative angle?
Or is this a highly calculated test of Western defense supply chains? Think about the timing. This is being executed right at a moment when the world's diplomatic and military attention is heavily distracted by the ongoing crisis in the Middle East. Right. It forces you to wonder if this is about stressing the system when it's already looking the other way.
That is exactly how the commodity markets seem to process the risk. Because when you have coordinated strikes on critical energy nodes, it ceases to be a localized event. It actively threatens broader supply chain stability across Europe.
And we saw gold react instantly to this.
Oh, huge reaction. Gold futures spiked from an overnight session low of 4,042.80 all the way up to an intraday peak of 4,157.10.
Which is a violent rotation into a traditional safe haven. And for you listening, the mechanism there is that when supply chains for essential resources like energy are threatened, fiat currencies linked to those economies look really vulnerable.
Yeah, capital flees that uncertainty and runs straight into the most physical store of value we have.
But what's crazier is that Eastern Europe wasn't the only geopolitical flashpoint overnight. We have to look at the reports that dropped right before the closing bell the prior day regarding the Strait of Hormuz. That was July 1st at 4:27 p.m. Eastern Time.
Right. Despite all the diplomatic mediation efforts happening in Doha, Iran's unified command came out and openly demanded transit fees for commercial ships passing through the strait.
And they didn't just ask nicely. I mean, they warned of a swift and decisive response to any U.S. interference in their collection of these fees.
Yeah, and the practical fallout of that is immediate. You have European nations apparently just accepting that paying these extortion costs is inevitable if they want to secure passage for their energy shipments.
Wow, just accepting it.
But on the flip side, you have major corporate players like Nordic American Tankers publicly stating they're pulling their ships entirely out of the Arabian Gulf. They simply won't risk the assets.
This is the literal definition of geopolitical brinkmanship as leverage premium. It directly translates into higher localized shipping costs, which then delays the normalization of the entire global energy supply chain.
It places a persistent friction in global shipping. That friction acts as a fundamental floor under inflation expectations. You just can't logically price in a smooth, disinflationary environment when moving oil through a major maritime choke point suddenly requires paying a geopolitical tax.
Or rerouting your entire fleet around a continent, yeah. Now, to round out the overnight setup, we also saw a major shift out of Asia late last night. Japanese authorities have totally ripped up their foreign exchange playbook.
They absolutely have. This was reported July 1st at 11:35 p.m. Eastern Time. Japanese authorities have pivoted away from their old strategy of simply giving early intervention warnings.
Right.
Now, they are actively targeting currency speculators in the open market to stop the yen from depreciating so rapidly. When speculators short the yen, the BOJ is stepping in to punish those trades.
Yeah, and to back that up, we had comments from Bank of Japan policy advisor Nagahama calling for steady interest rate hikes every 6 months just to rectify the yen's weakness.
So if you step back and look at the board right before Wall Street opened, you had a potent cocktail of anxiety. Geopolitical risk driving up gold, transit extortion keeping a floor on global shipping costs, and a shifting global liquidity picture out of Japan.
Which set a deeply tense, fragile mood for the morning. We are going to take a really short break, but on the other side, we'll dive straight into the U.S. data shock that sent Treasury yields plunging.
Well, So shifting gears to our next question, what moved markets during U.S. trading hours? Because all that overnight anxiety we just talked about was immediately overshadowed the second the clock hit 8:30 a.m. Eastern Time.
Yeah, the undisputed main event was the U.S. employment report, and there's no way to sugarcoat it, Mira. I mean, this was a massive miss. The consensus forecast was that the U.S. economy would add 113,000 jobs.
Right.
The actual number then printed, just 57,000.
It's a staggering deceleration in hiring. I mean, to put that in perspective for you, when an economy the size of the United States misses its job growth target by half, that's not a statistical rounding error. It is a blaring siren that corporate hiring has hit a wall.
Now, the unemployment rate did tick down slightly to 4.2%, and annual wage growth held steady at 3.5%. But that headline payrolls number of 57,000 completely stole all the oxygen in the room.
And it set off an immediate, violent chain reaction across every single asset class. Traders instantly looked at that 57,000 number and realized the Federal Reserve's hawkish stance just lost its foundation.
Totally evaporated.
Before this print drop, the bond market had fully priced in the next Fed rate hike for October. Within minutes of that data hitting the wire, that expectation was pushed all the way out to December.
The repricing was instantaneous. You saw the U.S. dollar index drop down to 100.86, and the bond market was jumping around trying to find its footing, with 10-year Treasury futures bouncing in a really tight, tense range between 109.38 and 109.80.
Right, because of the discount rates, right?
Exactly. For the listener trying to grasp the mechanics here, it's all about discount rates as financial gravity. When rate expectations fall, Treasury yields fall. And when the yield on a risk-free Treasury falls, the future earnings of corporations suddenly look far more valuable on paper.
But the Fed was actively trying to manage this exact psychological dynamic right before the print even dropped. Around 8:05 a.m. Eastern Time, San Francisco Fed President Mary Daly gave some incredibly pointed remarks advocating for a gradualist stance.
She argued that current policy is slightly restrictive, but emphasized heavily that the Fed cannot give false guidance on rates right now.
Right, which is a perfect real-time example of the policy guidance blackout as uncertainty premium. When the central bank explicitly refuses to hold the market's hand and tell them what's coming next, bond markets get incredibly jumpy. Every single incoming data point gets heavily scrutinized.
But I want to push back on this euphoric bond market reaction for a second. Look at how traders celebrated the idea of delayed rate hikes today. You have to ask, is this leading explanation just way too neat?
What do you mean?
Like, is a single 57,000 jobs print a definitive trend break that guarantees a soft landing? Or is this just a statistical blip being wildly overextrapolated by traders absolutely desperate for a dovish pivot?
That is the trillion-dollar question. We have to remember that financial gravity concept. Yes, a weak jobs number means yields might fall because rate hikes get delayed.
Right.
But if economic growth stalls out too fast, if that 57,000 print is the beginning of an actual contraction, it will not matter if yields are falling. The earnings side of the valuation equation will collapse.
Yeah.
And if corporate earnings collapse, that pulls equity markets down into the abyss.
It's the ultimate be careful what you wish for scenario. Falling rates are great right up until you realize they're falling because the economy is breaking.
Exactly. So that shockingly weak jobs report threw a massive lifeline to duration-sensitive assets by pushing rate hike bets out. But it also injected a quiet anxiety about underlying growth. We're going to take another quick break, and when we come back, we'll reopen with the absolute carnage in the tech sector during the afternoon session.
All right, welcome back. We are moving to our third core question for the day, corporate events recap and what to watch next.
We teased this divergence at the very beginning of the show, but we need to detail just how violent the intraday reversal in the tech sector was today. Nasdaq futures hit an early intraday high of 30,320.00. Everything looked fine. And then the bottom just completely fell out. It collapsed all the way down to a low of 29,328.50.
A virtually uninterrupted 1,000-point drop. And the catalyst for this wasn't some macroeconomic data release. It happened right in the middle of U.S. trading at 2:55 p.m. Eastern Time during an internal company town hall at Meta.
Mark Zuckerberg stood up in front of his company and admitted that their AI agent development over the past 4 months just hasn't accelerated as expected.
Wait, he actually said that out loud?
He did. But the part that actually broke the Nasdaq was when he explicitly stated that their massive AI capital expenditures are putting a real strain on the company's financials.
This is the concept of AI capex as a cycle-agnostic arms race suddenly crashing headfirst into a very real corporate budget constraint. For months, the dominant narrative on Wall Street has been that these tech hyperscalers will spend whatever it takes to win the AI race.
You'll buy every chip, build every data center, damn the costs.
Right. But Zuckerberg just admitted that the spending is hurting their financials today, and the magical software breakthroughs they were banking on to justify that spend aren't materializing on schedule.
And for you, as an investor, you have to understand how this triggers multiple compression. Investors are paying a massive premium for every dollar of tech earnings because they assume AI will make those earnings multiply exponentially.
But if that AI growth hits a wall, the premium investors are willing to pay shrinks rapidly. That is multiple compression, and it can wipe out trillions of dollars in market cap in an afternoon.
But what makes this genuinely terrifying is how this strain cascades through the entire financial ecosystem. Because the leverage in the system is building up rapidly. Look at the news that dropped late the previous night at 11:32 p.m. Eastern Time regarding NVIDIA.
Yes, this is a massively underreported story. NVIDIA is now partnering with specialty AI cloud providers, but they're actually providing credit support and taking a direct share of the revenues to help these smaller providers buy NVIDIA's own GPUs.
And if you combine that with the other massive headline that SoftBank is in active talks for a $10 billion margin loan backed almost entirely by its stake in OpenAI, you start to see the systemic risk building up in the plumbing.
It is the literal definition of private leverage as public market contagion. You have private, illiquid startup valuations being used as collateral to pull $10 billion of highly liquid credit out of major Wall Street banks.
Right. And simultaneously, you have NVIDIA acting almost like a shadow bank itself to ensure its chips keep selling.
When Wall Street sees these intricate, highly leveraged financing schemes acting as the foundation of the AI boom, and then simultaneously hears Mark Zuckerberg say the software development is stalling, that is exactly why the Nasdaq drops 1,000 points. The leverage requires perfection.
And Zuckerberg just admitted things aren't perfect. The contrast within the tech sector today was really stark too, because while Meta was admitting to deep financial strain over AI, you had Tesla releasing their numbers right after the opening bell at 9 to 3 a.m. Eastern Time.
Right. Tesla actually beat their Q2 delivery estimates. They successfully delivered 480,126 vehicles.
Yeah.
But the detail that caught everyone's eye was a leaked internal memo showing that Tesla capped their internal employee AI tool budget at just $200 a week.
It is a striking juxtaposition. You have the company most famous for pushing full self-driving, heavily rationing its internal AI software spend for its own engineers, while Meta is stranding its balance sheet trying to build the infrastructure.
It paints a picture of a sector suddenly realizing money isn't infinite.
Definitely. I mean, with Silicon Valley suddenly on a strict budget, with Meta screening its financials and Tesla capping AI tools at $200 a week, tech engineers are soon going to be sharing a single ChatGPT Plus subscription and coding on Google Docs just to keep the lights on.
That's hilarious.
And meanwhile, with OpenAI reportedly offering the White House a 5% equity stake, the president might start signing executive orders with a regenerate response button. But hey, if that 1,000-point Nasdaq roller coaster wrecked your portfolio today, just tell your creditors you're taking a gradualist approach to your repayment schedule.
I am sure the banks will be incredibly sympathetic to that argument. So, with all of this volatility, what do we have to watch next over the next 24 trading hours? First of all, keep in mind that on Friday, July 3rd, U.S. markets are entirely closed in observance of Independence Day.
So we actually won't see the real follow-through on this tech volatility until the market reopens on Monday.
Exactly. So looking ahead to Monday, July 6th, at 1:20 p.m. Eastern Time, we have the New York Fed bill purchases, which will give us a read on market liquidity. At 1:45 p.m. Eastern Time, we will see the June S&P Global Final Composite and Services PMIs. Then the big one, at 2 p.m. Eastern Time, we get the June ISM Services PMI. You are going to want to watch the prices paid and employment sub-indices closely. Finally, at 3:30 p.m. Eastern Time, we have the 3-month and 6-month Treasury bill auctions.
A lot of data dropping right as the market tries to digest